Hello, I'm Bryce Norris, Senior Editor of Farm Futures Magazine. Welcome to The Buzz for Wednesday, May 15th, 2013. Market analyst Paul Bergner joins me to provide a mid-month update on markets that remain full of drama. While conditions for planting new crop are on the minds of producers, most of the real news came from old crop, especially in the soybean market. Tuesday's fireworks were from May futures contracts, which stopped trading with the flurry due to very tight old crop supplies. May traded to the highest level on the nearby chart since November 2nd, finishing at 1524.5, moving almost $2 off April lows. Old crop exports continue to wind down as more beans are being shipped out of South America, but meal prices here in the States remain on fire as domestic crushers scramble to find beans. Today's April data from the National Oilseed Processors Association showed 120.1 million bushels used last month. That was about 5 million bushels below trade guesses, but it kept the year-to-date total 4.8% above levels from the 2011 crop. USDA currently forecasts a 4% drop for the entire marketing year, suggesting severe rationing is going to be needed this summer. New crop contracts benefited from a combination of demand and weather. USDA announced another sale to China under its daily reporting system for large purchases, and better weather for corn planting this week helped keep November futures above $12. Paul, have old crop cash prices peaked out with the May expiration? And how long can November hold on to a $12 handle?
Well, I do think that maybe we did find that peak on those old crop prices. There could still be some upside yet there, but I think the cash market seems to be taking care of that instead, as you know those basis numbers are getting awfully strong in the soybean market. So I think that's there. On the new crop, it's really interesting. I think one of the other things that happened yesterday was some more labor issues in Brazil. That's playing a role as to what's going on. Um, that I think is bringing the Chinese back in with really that big appetite for U.S. beans and really trying to get some stuff lined up just as quickly as we can get new crop beans into the market. They're going to shift just to stay away from some of the issues that are going on there. The other thing that's out there for me, a new crop, is soybeans are only 6% planted. You know, the number on that is well below normal as well, and I think that that's maybe holding a little bit of strength there too. Wondering if we do shift some acres, whether or not we can get them planted in a timely basis, and really. We don't show a real big history of shifting a lot of acres from corn to beans, so it'll be interesting to see. But I think that $12 number is still going to sit there as good support, at least in the short term.
May corn futures followed May beans higher this week, finishing with a close at 706 3/4 for a last hurrah. July corn started the day weaker today, but got a jolt from last week's ethanol production numbers. Margins improved in some parts of the Corn Belt to attractive levels, allowing plants to keep on grinding. Production matched the post-drought high set 2 weeks ago, while stocks fell again, reaching their lowest level since November 2010. While overall gasoline demand is weak, production is increasing seasonally to meet summer driving demand, so blenders need more ethanol. I continue to think the old crop stock story could be setting up potential for volatility with USDA's June 28th inventory update. Pollination of the late planted corn crop will be happening about that time, so a surprise could make weather rallies all the more interesting. Triple-digit readings in the western Corn Belt this week were a reminder of how variable that weather is. After planting progress at the end of last week was at an all-time low, farmers were running flat out this week, raising potential that half the crop will be in by Sunday. With more rain into early next week slowing progress again, traders are beginning to dial back their estimates of acreage. A loss of 1 to 2 million acres is in the air, but that would only reduce production 300 million bushels or so, unless yields fall sharply too. That's one reason December futures remains subdued. What's your opinion, Paul? Does December deserve to have more weather premium?
Well, I think there's a couple of things in play there. That lost acres number, now recognizing that we've not historically thrown a 97 million acre number out there, maybe it is a little easier to pull a million acres off of that very large number. But we haven't historically pulled an awful lot of acres away from corn. We'll go ahead and plant that corn a little bit later. Typically. So it'll be interesting to see that where that goes. What I believe the bigger chance is more losses on the yield side. I'm not sure that maybe we shouldn't be thinking a lot closer to 150 bushel crop as a starting point instead of the 158. So maybe it's a yield side issue there. I do think probably should be a little bit more strength in the December corn. I'm thinking in the 550 range. I'm not quite excited about going to $6 with December corn unless some further issues come along. But I think we're a little soft on the corn price for December.
With all the attention on corn and beans, wheat flew mostly under the radar after last week's USDA report. That wasn't good for prices, however. Chicago July broke its April-May support line, falling below the 50-day moving average and looking more like it wanted to start a break into harvest lows. Kansas City held up a little better, but Minneapolis is also looking weak. One source of worry was an export market that remains subdued in many areas. Many buyers, especially those in the Middle East, appear to be waiting for cheaper prices this summer. U.S. prices could be at a disadvantage if the dollar continues to strengthen, a trend that punished many commodities, especially gold, which lost some $30 an ounce Wednesday to fall below $1,400 an ounce again. Paul, crops on the plains continue to face hurdles. Why isn't the market getting more excited about wheat?
Well, I'm not sure that hurdles is quite the right word for it the way this crop is going. I think we may be trying to get over a high jump bar or something at this point. It's really a challenge as we look at this wheat crop, and I think we're still really very far from comfortable with yields, and I think that's part of what's out there. The crop is immature in the northern part of the plains, and maybe that's where folks are hoping that there's still some opportunity there. When we start looking at what's happening south of I-70 in Kansas, then we have some different issues. The heat this week has been really as bad a condition as you could get for that wheat in the southern plains. Those guys are either heading or early grain fill, and this kind of heat is not good. As we think about what happened in 2012, we actually filled that grain well ahead of when the heat came on, and we got a better than expected crop from it. This could be just the opposite impact. We could actually be a little bit later. We're definitely going to be much later in the north, and I think that could have a significant impact as we try to get through heading and grain fill in the hot heat part of the summer. So I think there's some upside in those prices, but I think the market is still waiting to see whether or not there's anything out there to work with.
Well, thanks, Paul. We'll be back next week with an update on planting progress on the next edition of The Buzz.
We'll have to have more margin now, there isn't any doubt. So you better dash with the load